Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Brian Hamrick. Thanks for being on the show, Brian.
Hey, Whitney, it's great to be here. Thank you.
Yeah, honored to have you on the show. Brian controls over $32 million in apartment, self-storage, and office commercial real estate, as well as performing and non-performing notes. He's raised over $9 million from investors through syndications and funds, and he also hosts the Rental Property Owner and Real Estate Investor podcast. Brian, welcome to the show. Give us a little more about your focus in real estate, and let's jump into your superpower and the thing we're going to just dive into today to help the listener.
Yeah, absolutely. So, Whitney, thanks for having me on your show. I'm an opportunistic investor. I invest in apartments, I invest in office, a little bit of retail, self-storage is one of my favorites, and performing and non-performing notes. And I've also dabbled in some ground-up apartment development too. So I've done a lot, worked with a lot of great partners, and I always like to come prepared to shows like yours. And bring my A game. So I actually thought, I've had a lot of conversations in the past couple months about fund structure because I've started a fund. I spent about a year trying to figure out how to do a fund. And if it's okay with you, I'd love to talk about fund structure today. It's not necessarily my superpower. I'm not an attorney, but I've certainly gone down that road and would love to talk about it.
No doubt about it. I would love to talk about that. And I appreciate you just bringing it up and that spending a year of research learning this, you're going to be, so much more knowledgeable about this than I am for sure. But it's just that you've done it too, but I want us to get into, what you're talking about versus say the normal syndication or deal by deal syndication that some people have heard called different things. And you just elaborate on the pros, cons, and we'll get into some of that. So thank you for that. Thank you for being on the show, but let's jump in. Tell us a little about I guess I want to back up. I was going to say the fund that you did, but back up a little bit to even your research for a year. Where did you go to find research? What were the main things that helped you, Brian, to learn even, most of the things you're going to share with us today?
Well, I looked for books on the topic, could not really find many books. I went to networking events, national networking events, and probably that's the best source to find people who have actually put their own funds together and talk to them and say, why did you structure it this way? How did you structure it? What were some of the considerations? And really, when you talk to 10 different people who have started 10 different funds, you get 10 entirely different answers as to how they went about it and what kind of structure they have. So it can be confusing and daunting. And but before I get into that, let's make sure people understand what a fund is and how it's different from a syndication. Because I've certainly syndicated apartment buildings, self-storage. These are single asset syndications where you identify the property. You identify the closing date, you go out, you raise your money, and once you close, you've got your investors, they're locked in, and maybe you hold it 5 years, 10 years, whatever, but that's a single asset syndication. And I know you've done 100 million in syndication, so you're very familiar with that process. Now, but let's say you want to go out and you're not sure what you're going to buy. But there's a lot of retail right now because of the coronavirus pandemic, there's a lot of distress right now in the retail area. That's what I mean to say. And let's say you want to go out and just pick up distressed retail centers, shopping malls, strip centers, things like that. But you're not sure exactly what the asset is going to be. So you might start a fund that is meant to raise the money before you identify the asset. And it could be multiple assets that you would pick up in this fund. And that's why you would do a fund structure as opposed to just a single asset syndication.
Okay, so there's a lot to think through there, right? Why we would do this and when and who should do this. Maybe even some of the timeline, people are thinking, okay, well, when am I going to be raising the money, or when's it going to be deployed, and some of those things working or to think through. But maybe we can start with even the the types of properties we should be thinking about acquiring, or do they have to be the same, or can we purchase different types in that fund? Just elaborate on that some.
Yeah, so I'm not going to talk about any fund that I may or may not have done because it's a 506B, but I'll just kind of take you through it in general, kind of from a general perspective, because I'm not an attorney or a CPA. So you should always, of course, talk to your experts on your team about these things. But as far as identifying the asset, if you're an apartment investor, you might say the assets that we're going to go after are distressed assets that are in the 20 to 40 unit range. And we're going to pick these up for $1 million to $1.5 million each. We don't know what they are yet, but we're going to raise enough money so that whenever we see those opportunities, we can close quickly because we've already had commitments for the funds to close. And we may not even need lender financing because we'll be raising that money from our investors. So that's from the asset side. You want to identify what the asset is going to be. Is it going to be apartments? Is it going to be retail centers? Is it going to be cryptocurrency? Whatever it might be, identify that. But then also think, well, what if we're investing? What if we're only going after retail, but we come across an office building that's distressed that we can pick up and it makes sense? Do you want to widen the parameters of your fund and make sure that, it's transparent to your investors in such a way that you as the operator have the leeway to include office in your retail? So you have to take these things into consideration when you're putting together your fund.
Any kind of time frame restrictions or the duration of the fund, things like that we should be thinking about?
Well, yeah, that's always important because if let's say you're buying apartment buildings, well, what is your window of time that you need to be able to acquire these? Is your fund only going to be open for a year? You're going to acquire these assets, achieve the upside value, and dispose of them within 3 years, 5 years, 10 years. You need to figure that out. And because you're on kind of a staggered schedule, you don't know when you're going to find the asset. You don't know when you're going to close on it. You don't know how many assets you're going to find and over what period of time. You need to build that flexibility into your fund to say, you know what, this may not be your traditional 3 to 5 year fund. This may be a 7-year fund or a 10-year fund. And you have to really think about it in that way as to, well, how are you going to get your investors in and how long do you need to let them know that they're going to be in that fund?
They definitely are going to want to know, right? They're going to want to know when all these things are going to happen. And so you better have an idea about this time period that you're projecting. But, thinking about those people that you're talking about, those investors, you have to project some kind of return, right? And how do you do that or the returns you'll be offering to investors?
Well, so that's I always say that's a marketing question. You have to know your investors. What are their timeframes? I mean, I have investors who are in their 70s and they've told me, I don't want to invest in something for 10 years because I may not be around for 10 years. So, does that mean I need to make it a 5-year fund? And would that even work with the type of asset that I'm buying under the parameters under which I'm buying them? The returns are always different. And like I said, you talk to 10 different fund operators, you're going to get 10 different answers. So I've talked to operators in the note world who basically their fund is you invest with me and you're going to get a straight up 8% return. If you invest over 150,000, I'll make it 9%. And that's it. It's just a flat. There's no equity upside to that. And then you have other people who structure their fund much like we might structure our syndications, where you have a cash on cash preferred return each year. And then an IRR, an internal rate of return or annualized return, that's 18, 20% once you liquidate. The problem is because it's kind of a blind pool. You don't know exactly what asset you're buying. So you're not able to run the numbers really completely before you raise that money. You don't know exactly what the returns are going to be. So you have to make sure you build in all kinds of cushion and take into account all kinds of variables to be able to get to a return that your investors will get excited about. Because again, it's always a marketing issue. You don't want to come out with a 4% preferred return and 5% annualized return because investors will just say, well, I can go to Whitney and do much better. So you want to make sure it's sexy enough for your investors, but not overly sexy in which you can't deliver.
Are there any other things about just specific ways to provide those returns, or that you're providing them to investors?
Well, there's the easiest way is just a straight up preferred return. 8 to 12%. That's what you're going to get, and it's a 5-year fund, and we'll get you your money back at the end of 5 years. That's the easiest way because it requires very little bookkeeping. As you get into more detailed returns with preferred return, cash on cash, annualized return once you dispose of the assets, then there's a lot more bookkeeping. And it's very easy with the cash on cash return to say, all right, when this investor invested from this date, their cash on cash return starts there. They get a certain percentage prorated for the amount of time they've been in. But when you get to the annualized return, which is once we've disposed of all the assets in this fund, we've paid back our investors, and now we're going to pay out the profit, you need to be able to make sure that the people who got in early and the people who got in later are being compensated equally, or their compensation is balanced, because you don't want to have a lopsided fund where the later you get in, the more profit participation you're going to get in the back end. So that was something that I really had to struggle with to figure out mathematically, well, how do we make sure that someone who gets in early is going to have the same annualized return or internal rate of return as someone who gets in late? And that was probably the biggest challenge. And I do you want to hear the answer?
Yeah, well, of course.
Okay. So what you have to do is you have to take a weighted ownership ratio for each investor. And that you're basically weighting the number of days. When I say weight, it's WEIGHTING, weighting the number of days that they're in the investment with the number of units or shares that they've purchased. And then that gives them a percentage of ownership that is then applied toward that annualized return when it comes time to pay that out.
Now, do you use some kind of software? I mean, obviously we know lots of portals and things like that now that a lot of us are using. But is there something that helps you to calculate that?
I use Excel. So I've got an Excel spreadsheet. I'd be happy to share my template. If anyone's interested, they can go to my website or email me, and I'll share it. I'm also going to have a white paper ready by the time this comes out. So I'll put down any additional thoughts on putting a fund together. Again, I'm not an attorney, but I have done it, and I've talked to many people. So I'd be happy to share what I know about the topic.
Cool. Well, I mean, can the shares or the value of the shares change in any way through the life of the fund, or does it have to stay the same?
Well, I think that your percentage ownership as an investor is changing constantly, because as new investors come in, they're bringing more money. That disrupts the change of ownership. The value of your share can also change as the fund acquires more assets. That certainly happens. And you just reminded me of another way that one of the fund operators values the investment is, rather than just have a straight up, each share or unit that you purchase is $1,000 each, $50,000 minimum, 100, whatever. As they bring in new investors, they will actually revalue those shares. So a share that might have cost $50,000 a year ago might be worth $86,000 now. That's a little bit more detailed, because then they have to go and they have to get valuations on all the assets and really make sure that they're clear on each individual asset and its value and how it's changed over time. But that is one way that I've seen people do it, is to revalue the shares as new investors come in, much like you see in the stock market.
Are there normally like waiting lists for a fund like this, or do you have soft commitments versus hard commitments? How does that work?
Yeah, so that's another tricky part, because again, you're going out and soliciting investors, bringing investors into your ecosystem without having identified the asset yet. You've identified the asset class, but not the asset. So it's a delicate balance to get investors excited about that, get them on a waiting list, get them to subscribe to a waiting list and make a soft commitment. And a soft commitment is just that. It's not a hard commitment where my money's ready to go. It's just, I'm in line, I'm interested in investing. And when you get to me, we'll see if I actually have that money to invest. The delicate balance is if you get too many investors in line with their soft commitments, but you don't come through with the product and the pipeline isn't there for what you're trying to raise money for, those investors might get discouraged and go invest elsewhere. So there is a delicate balance, and you have to be very mindful of not overpromising to your investors as to how quickly you're going to be able to deploy the money. And that brings up another very important issues where people do get in trouble quite often when doing these funds, is they raise the money before they actually have the assets identified. So, and that's a problem because then you're paying a preferred return on assets that haven't even been purchased yet or identified. So you want to make sure you set it up, or it's preferable at least to set it up so that you're only raising the money, or actually bringing the money into your fund as you have the opportunity to deploy that money.
And some of that there, I mean, you hinted on it a little bit, but I wanted to ask you, just like when in someone's career should they consider a fund like this? You obviously, I mean, you need that relationship with investors, right? Before probably you do a fund like this, but what's your take on that?
Well, I think, look, syndication is much more preferable. In my having done both, it's much better to identify the asset first, figure out the value, figure out the returns, and then go to the investors. The reason you would consider a fund is if you have a pipeline of opportunities, or you anticipate a pipeline of opportunities that you want to move quickly on. There's a lot of talk about distress in different sectors of real estate. And if you have some sort of pipeline to help out in that area, then it's a good idea to maybe start a fund, because then you won't be bogged down each time on each individual asset trying to raise money for it. You'll have raised the money for a pool. And in this case, it would be it's a blind pool. You don't know exactly what the asset is. You know the asset class, and it could be an open-ended rolling fund where you don't know when you're going to close it to investors. And it's rolling in the sense that you'll bring investors in as you have opportunities to deploy their money.
I wanted to clarify also, I know, you briefly mentioned like you were doing a 506B fund, but I want to talk about B versus C just briefly, because we've talked about that on the show a lot. And so most listeners are going to understand some of the differences there. But as far as a fund's concerned, if you're doing a 506B, you have to have that pre-existing relationship when you start the fund, right? I mean, you can't, and it's not on a deal by deal basis then. It's going to be when the fund started. Is that correct?
Yeah, absolutely. So, that's something else to take into consideration too. What is the raise? How much are you raising? Is it a $1 million fund? In which case, maybe as a 506B, you have those pre-existing relationships. Is it a $20 million fund where maybe you're better off with a 506C so that you can go out and bring in investors, accredited investors who you don't already have a relationship with? And that's a big question too. What is the limit? What is the amount that your fund is going to raise? And
I was thinking too, if the hold period was 2 years or 5 years for this fund, you may want to be able to bring new people in over that long period of time.
Absolutely. And that's part of the calculus that you have to put into the thinking process. Who are my investors? Of the investors that I have exposure to, are they going to be able to help me with a $10 million fund? Do I need to go wider?
How soon are distributions paid? I mean, I know you talked about that a little bit also, but just if the investor is listening, he's thinking about investing in a fund, how soon should he expect a return?
Yeah, you have to be very clear on that. If you're buying distressed property, let's say go back to the retail example. If you're buying distressed retail centers that may have non-paying tenants or vacant storefronts, you're not going to be paying out in the first 6 months, maybe not even in the first 2 years. So you have to be very clear with your investors as to what to anticipate. And I've seen it where people, we all know people who overraise and then start paying out as quickly as possible. I think that's a problem when it comes to fund, because you certainly don't want to be paying investors out of money that you're raising from investors. You need to be paying them from the asset itself and the cash flow that's coming from that asset. So, it's not always possible to start paying quickly. And again, that's a marketing issue. I mean, our investor is going to say, well, sure, I'll wait 3 years for you to start making money. But I'm not going to be happy with a 6% return. I'm going to want that 20% IRR or annualized return or whatever it may be. So again, there's no one answer to that but you do have to think through, what is the timeline? What should I set my investors up to anticipate when they'll start seeing some money?
And how does an operator like yourself make money in a fund like this versus normal, individual deal syndication?
Great question. So, there's different ways. It's very similar to syndications. I mean, an equity share. If you pay a preferred return, you get the waterfall distributions after that preferred return is met. I think it's important to make sure your investors know that they're getting paid before you do, whether it's a syndication or a fund. But I do think that even though I've not done a asset management fee or any sort of management fee on my syndications, on the fund, it's a little different because the fund is more work. So that's another way that you can pay yourself, is through some sort of asset management fee.
So Brian, what's been the hardest part of operating a fund or syndicating a fund like this?
Meeting investors' expectations and that waiting list. I think keeping that balance between keeping your investors excited about investing and then actually having that pipeline of supply for them to invest in. That's been the most difficult part. And when you put together a fund, you really have to think about your investors and consider them from every aspect, every viewpoint, to make sure that they are being rewarded for taking this leap with you, because it is a blind pool. They're not exactly sure what they're investing in, nor are you when you put it together. So they're really investing with you as the operator. And you have to, be aware of that and treat it with respect.
And what about preparing for a downturn when operating a fund like this?
Yeah, it's the same as with a syndication. I mean, how do you prepare for a downturn? You don't overraise. You don't raise money that you can't deploy right away, and you try to keep your liabilities limited as much as possible. I think if you do overraise in order to have operational funds, that's important to make sure you have enough money to operate, because there are expenses to keep that machinery working smoothly. But I lost the thread of the question.
No, that's all right. You're just talking about a downturn. You answered it.
Downturn, just the same thing.
What about
syndication?
Yeah. What about just your prediction for the real estate market over the next 6 to 12 months?
I've heard all kinds of predictions from all fronts. I mean, we're heading into a great recession. The housing market is going to collapse. I don't believe the negative. All that could certainly happen. The negative could certainly happen. I think it's going to be asset by asset, location by location. I've heard about a lot of distress in apartment assets across the country, but I have to say, here in Grand Rapids, Michigan, my apartments are humming along very nicely. We've worked well with our residents. We've helped those who have had trouble. And we're doing very well. We're doing as well this year as we did last year before the pandemic. But I know there are places where maybe they're lucky if they have 70% of their collections. Mm-hmm. I think it really depends. I think residential is going to stay strong. I don't anticipate a housing collapse like some do. I think residential will be good. I think the asset classes that have held up really well, like self-storage, will continue to perform really well in markets where it's not been overbuilt. I think senior housing has really hit a lot of trouble and a lot of speed bumps lately, but that's going to come back in the next couple of years because the demand is going to be there. But I do think there will be some distress in the mortgage world, both commercial and residential. I think that there will be opportunities for non-performing notes.
Do you have any daily habits, Brian, that you're very disciplined about that have helped you achieve success?
Simple daily habits. I try to exercise a little bit each day, whether it's just going for a walk or working out. I always have the same breakfast every morning. I always make my bed as soon as I get out of it. So those are my simple habits.
Nice. I encourage you to have something different for breakfast tomorrow.
Well, I try to be creative with the same, maybe I'll add some different vegetables, but it's always a fried egg.
What's your best source for meeting new investors right now?
I host the podcast, the Rental Property Owner and Real Estate Investor Podcast. I've met so many investors. I've met partners through that podcast. That's really the best source. Networking is always great, but I haven't done much of that lately.
What about the number one thing that's contributed to your success?
Finding rockstar partners. Partnering with people who really know their area, the asset class, and are real troubleshooters and know how to get things done.
So real troubleshooters, not troublemakers, right?
The troubleshooters know how to keep the troublemakers at bay.
That's right. So, Brian, how do you like to give back?
Well, I think, Whitney, I know you host your podcast, and I feel like we're both giving back to our audience through the podcast because we've had a certain amount of success in this area, and it's important for us to share that as much as possible. And that's why I prepared what I prepared for you today. I share a lot of information on my podcast with the people I interview, and I'm looking forward to interviewing you soon. I am philanthropic. I can't say I'm at the level that you are. I'm very impressed with the work you do. But I just think helping people get to that next level. That's how I love to give back.
Awesome. Well, Brian, it's been a pleasure just to get to know you a little better personally and have you on the show and dive into a fund and things we should be thinking about I get the question often as well. Should I do a fund? Is this the time, that the big thing's fixing to happen, right? Where they're going to have all these deals, whatever that may be. And so we want to have all this money ready and people are asking questions about that. So I'm grateful for your time today, just going through things we should be considering, especially as far as our investors is concerned and our business and things that you've elaborated on when structuring and operating a fund. But Brian, how can people get in touch with you and learn more about you?
So go to my website. It's higinvestor.com. That's higinvestor, INVESTOR.com. You can email me at Brian, BRIAN, at higinvestor.com. And listen to my podcast, the Rental Property Owner and Real Estate Investor Podcast. And Whitney, I'm going to put together a white paper about this, and I'll include my spreadsheet so people can see how I weight each individual investor's days that they've been invested and the shares that they've purchased. And I'll make that available, whether it's on my website or you can email me. And I'll have that ready by the time this episode comes out.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.